Well, greetings everybody and welcome to an experiment. This is kind of a prototype. Let me check your screen here real quick just to make sure that, okay. All right. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by Kim Butcher. Kim, say
Hi,
hello.
everybody.
So you can see,
I'm
actually
down
see
here in
both of
Florida.
us. Kim
Yeah.
is down in Florida. She comes to us by way of Evansville, Indiana, but she's spending quite a bit of time down in Florida. But basically, what this amounts to is we would like to experiment with a weekly webcast, quite informal. We have named it Bull Session, and that's a dangerous title because people can get carried away with that. And frankly, every once in a while, there is a little bit of bull, um, the bad kind of bull in the stock market. But in general, a community of long-term investors, and that's why I love this picture that's on the cover slide, because that's the way I think of the bull market. If you go looking for images of a bull to put on slides, you're going to find that 95% of them are either angry or charging or alone or rogue, um, and generally pretty nasty looking pictures and that sort of thing, like the running of the bulls in Spain, that sort of thing. But I think this picture better is more descriptive of our community, where we are a bunch of bulls who come together to share ideas and opportunities and that sort of thing, and a little calmer about it. And that's kind of the type of theme that we would like to have for these sessions. We do believe that we're better together, and we'll talk a little bit about it at the end, but what I'd like you to give some thought to, this is an experiment. It's a prototype. Is the weekly frequency something that you would like? We kind of picked Tuesday out of the blue. I like Tuesday because many of the weekly updates are kind of coming into shape. Um, the time, 2 p.m., obviously some people are uncomfortable with that because they still have day jobs. We are recording it, and we will put it in the forum at Manifest Investing. So anybody that can't attend it in person can certainly access it later. We'll put the session notes and links and that kind of stuff and make it available to everybody. But welcome, and let's just have some fun. We are going to stick to investing themes, and we'll probably focus a fair amount on tools and resources that we have at Manifest Investing. But let's go ahead and get underway. Just as a quick reminder, this is an educational demonstration. No investment recommendation is intended. We'll talk about real companies in real time. Most of you know the drill. Everything's for demonstration, illustration, and we are conveying the interpretation of a philosophy and a method of gauging opportunities. Many of you are already familiar with our monthly webcast that we do on the last Thursday evening of every month called the Roundtable. And if you want to be added to a reminder list about that event and some of the educational type webcasts that we do, you can send an email to ncavula1@comcast.net. If you have follow-up questions or you'd like copies of the slides here, my email address is on the screen, markr@manifestinvesting.com. So let's go ahead and talk a little bit about this. Like I said, I think the image there is much friendlier. A group of bulls trying to basically meander their way through a market that we all know it kind of zigs and zags. It's not a straight line up and down. And this is just a quick reminder that we want to keep it informal. The microphones will be open. If you have questions or comments, you can enter them in the questions tab or raise your hand. And we'll attempt to work through that type of a format. All right, one of the things that I'd like to do is kind of spend a couple minutes before we open the field up for some questions is cover some main themes. Here's the stock market as measured by the value line arithmetic index for the last 20 years. And the value line arithmetic average, again, is about 1,700 companies in the value line standard edition. And we track this on a fairly regular basis. And you can see from left to right, pretty good picture, but there have been speed bumps along the way, and then there have been Grand Canyon-sized speed bumps in a couple of different instances, including that period back in 2008, 2009. And I'm not going to belabor all the stuff. You guys are all pretty experienced here in the audience today. And then what we've gone through here in the last few months, kind of a micro burst of action in the stock market. And Kim, if you have any comments on any of this, feel free to jump in.
I don't watch it as close. I notice whenever my stocks currently get to a 52-week high, this is what I like to check and see what it's doing. But I also go to point and figure charts to see what's happening. And I like sleeping at night, but I also I have a life to live, and I'm helping family here, so I don't necessarily keep an eye on the market and sit and look at the computer every day.
Understand, and that's the way many of us behave. In a phone conversation yesterday with Jay Berry, I think he thinks I spend 20 or 22 hours a day doing this stuff. That's not true.
No.
But there is a fair amount of time involved in it. One of the things I thought we might do here today is it's something that comes up at Manifest, one of our favorite charts, where we take a look at the performance of the value line average. That's an arithmetic, equally weighted average of the companies in the standard edition over time. And we basically put this chart together and publish it weekly. And thought we'd just kind of strip it down and take a look at it. You can see that, again, not a straight line from left to right. Definitely some speed bumps in a couple of the canyons that I mentioned. What we're basically looking at is, the turbulence of the stock market. And again, some moments like back in that time frame back in 2008, 2009, when things got pretty ugly. And then recently, December 2018, and then the current situation we're in here. The major takeaway from just noticing this is that over the long term, we're still talking about a 9 to 10% return on average, and that's actually down quite badly in the last year or so relative to the other measures of other benchmarks for the stock market. One of the things we love to do is stick to just the exponential regression. A reminder that, again, this is a linear scale. So what you're looking at is an exponential growth curve. And what this is suggesting is that somewhere out approximately 4 years from now, the value line arithmetic average will reach somewhere in that 10,000 range. And that's what you see over here on the right. Now, the thing that we talk about a lot is the fact that, every once in a while we get these periods like we've had a couple of times in the last few years when the green monthly price bars, those are actually quarterly price bars, actually edge up above the blue trend. And obviously there are the periods below, which we've referred to as chasms. We've had a few of them, and the current one is pretty sharp, and it's still a work in progress. It'll be interesting to see exactly what shape that takes going forward. But again, over the long term, pretty much attempts to track that blue line, and we use the meandering as opportunity. We don't see it as risk. This slide actually depicts if you had done stock studies on the value line inventory of companies. Again, you're talking about 1,700 companies. Again, these are quarterly snapshots. In this case, you can see that the return forecast, the average return forecast, is what is graphed in red, and that is plotted against the second y-axis over here on the right-hand side. And again, what kind of keeps us sane in these really nasty moments with the chasms is the fact that we're looking at all kinds of companies with very large long-term potential. Now, we didn't get a whole lot of shopping time on the most recent one. We had a few months back in this time frame. But again, what we're looking at is just this, again, reinforcing the reality that blue line's pretty reliable. I actually believe that it will be, we'll come in plus or minus to that 10,000 number and, pick great companies at great prices, and you'll do just fine between here and then. The other thing that we kind of take away is the market, through all of its spasmodic gyrations here over the last several months, has returned basically to fairly normal levels when it comes to these red lines. I mean, if you look at, where do most of these red dots fall? somewhere in here, and we're back to that after that excursion that went off the charts back in March of this year.
Yeah, and I'd like to add that it took me a long time to recognize when, as an investor, we have volatility in the market. That's great, because when we have volatility and the stock market goes down, that's when we can really get some great stocks at a wonderful price. So that's why it's always great to be able to have your pounce list available. And Mark, you can talk about how we can have that pounce list and how the dashboard can tell us what we should be pouncing on or keeping alerts on.
Yeah, one of the favorite things that we'll spend some time with at these weekly sessions is some of our favorite screens that you see us discuss. We most recently discussed a few of our favorite screens during the COVID cancellation conference last month. That's actually almost 2 months ago now. Yeah, well, that's one of our favorite things to do, is to engage in that, where we collectively explore opportunity. All right, just a quick reminder. I think very few people here need a reminder, but just in the case that you are new to this, we have been doing a monthly webcast for 10 years. Our 10th birthday is coming up in exactly 3 weeks. It's on a Tuesday evening at 8:30 p.m. Eastern Time. We're going to have some fun. We have had a great time doing it. We keep a tracking portfolio. Every month we've come together and shared, 4 or 5 of our favorite ideas at the time. The audience votes. It's been a blast. We have 4 regular nights. We have one fairly regular guest damsel, Kim, but we've had other knights and damsels over the years as guests. And it really is kind of fascinating to watch, what this community has done collectively. And again, you don't need to know any more than the rate of return has been 17% on those selections made. We take it fairly seriously. And that beats the stock market by approximately 7 percentage points. That's 700 basis points. And the long-term goal for many investment clubs is to beat that red line, that red dotted line across the middle. That means beating the stock market by 5 percentage points. And again, all that relative return is comparing your actual return and subtracting out what would you have gotten simply making mirroring investments or matching investments in some type of a total stock market benchmark. We use the Wilshire 5000, so you can see the difference between the two. So the fact that we are up in this zone is really cause for celebration. Puts us in fairly rare company. Now, if you as an individual investor, or you're in a club where you do happen to be down in this range, don't fret. I mean, that is still a wonderful position to be in, and those percentages add up over the long term. But again, the goal is to try to beat that 5% performance advantage to the general stock market. Here's a quick look at how our roundtable would stack up against some fairly substantial, and some of these are just really great performing mutual funds, publicly traded mutual funds. And QQQ's on that list, and one of our favorite small cap growth funds at the very top. T. Rowe Price New Horizons, those are sources of ideas for us. And the T. Rowe Price Health Sciences Fund are the only funds that have actually outperformed that roundtable tracking portfolio over the last several years. We look forward to finishing near the top of this list here in 3 weeks from today. All right, so one of the things I thought we might do, I don't know if Jay Barry is willing to go live audio-wise. Might check and see if he's willing to mic up, and if not, we'll just press on. I didn't prepare him for that, so this is going at it cold.
Yeah.
Well, you're unmuted, Jay. Are you ready?
I think so. Do you hear me?
Yeah, great.
Good afternoon, Jay. This was kind of inspired by you yesterday. If you want to just kind of recap for the audience your curiosity about the subject of screening and what we talked about yesterday.
Anyway, it was kind of called a remembrance. I was trying to remember what happened back a long time ago, and a couple of things I completely missed out on the time. The triple play, for example, I don't remember that coming up until recently. And I mentioned I also didn't remember this concept of a core holding being brought up. I think that's about the two things I mentioned yesterday.
Yeah, and like I mentioned, something I think I've read, and I'm going to show you in a second, the NAIC Investors Manual for the Individual Investor. I'm pretty sure you have that book. It's the handbook that they handed out in the 1980s.
Absolutely.
Picture of it. Well, page 96, Jay, was the answer we couldn't answer when we were on the phone yesterday. Page 96 actually talked about the triple play, and it's right there, and we'll have Kim demonstrate one here in a second. But what it amounts to is something that Nicholson had noticed, that when he went shopping for stocks, especially during troubled times in the market, much like we had fairly recently, could look for a depressed stock price and the capacity for margin enhancement, and combined with the possibility of PE expansion. And as you said, it's something that I don't think we've seen covered, didn't see covered at Better Investing in the community very often. I kind of stumbled onto this in the book, obviously, but also in association with an article that Nicholson had written back in 1975, I believe it was, March 1975, and that actually took us back to a few months earlier than that. So this was the first time I'd actually seen Nicholson write extensively about this, Jay. We talked about it. He talked about back in the time frame when you went to the gas station based on whether your license plate number was even or odd. Anybody remember those days?
Well, I do.
I mean, the gas was cheap, but the line stretched around the block, and we had shortages and just a really nasty time back. Well, back in that time frame, Coca-Cola was an attractive stock by virtue of the triple play. Nicholson engaged it. In fact, he wrote an article where he suggested that when you find something like this during a troubled market, be expedient about acting on it. Because he went on to point out that this went up, Coca-Cola went up, I want to say 60 or 70% over a span of a few months, and then it kind of flatlined for a few years, and then again took off again. But again, Coca-Cola from September 1974 through the next 20 years, 17% a year. That's pretty cool. So there is the definition. That's where we kind of were reminded about it as we were looking over some of the works of Nicholson. He actually wrote a column called Nicholson's World for Better Investing. And again, the thing that we were talking about yesterday was this notion of it probably does best in bear markets, nasty markets. And one of the things that we have done over the last few years is tested a few screens. And the triple play ends up being one of the market beating screens, but not quite as sexy and flashy as some of the ones up at the top. We're going to talk about two of those screens here today. The triple play, which again is edged out the market, but I think now is a great time to be having this conversation, Jay, because we probably are in a recession. They just haven't officially told us that yet. And we know that is the time when you basically go out there looking for triple play candidates and qualifying excellent, well-managed, fast-growing small companies. So we want to go after some of those. And we're going to talk about Prove, Prove, which is the top-performing screening thing here in a few minutes. So there's Nicholson's comments back from that time frame. We did cover it in an article at Manifest that you guys can find, that July 2016 cover article. And he was quite affirmative about this. And I could actually go back and look at some presentations that we've done over the years, again, in times when bear market conditions were at least around a little bit. And wow, some of the stocks that we have uncovered over the years and benefited from have really been a good thing. Any other thoughts on that, Jay?
Well, only a little bit of an excuse. Obviously it was there. I didn't remember since 1960. I thought I read all the Better Investing magazines that came in, but obviously I wasn't paying any attention to that. Now my excuse is I didn't retire until I was 1990. So in 1987 I was really busy working.
Yeah, that daggone working takes precedence sometimes.
It does.
Yeah. So I don't know. Looking back, I really don't know how I was so successful way back then. But obviously, I must have been because I kept using this, well, the NAIC principles all along. I've looked at many different approaches and so forth, but this is the one I've always come back to, and I'm very, very happy with the results.
Yeah, and I think any time that you remain committed to discovering excellent companies and waiting for them to be at an attractive price or on sale, so to speak, that's what we do. That is literally what we have done for decades, and you don't have to be flashy about it. It is quite rewarding over the long term. So one of the things I thought I would do for the audience, and this would be something we would love to do on a fairly regular basis, is I dug into the Manifest Investing database and basically spit out a group of companies that would pass a triple play screen. Okay, from top to bottom.
Currently, right now, Mark.
That's current as of today. So
yeah, that's one of the questions that we have in the question box. So you are working ahead of the questions.
Working ahead, who would actually fit the bill today? Well, this is an interesting list. What I basically did is I took companies that were in the top. I believe I restricted it to the top 20% of all companies by manifest ranking. That's this figure that you see here. And again, very quickly, for those of you that are unfamiliar with manifest investing and in our interpretation of this realm of investment analysis, we think that the return forecast, we use the projected annual return, always looking at the next 5-year time horizon. We're always looking at that return forecast, and then we also spend a lot of time on quality. We'll spend one of our weekly sessions re-emphasizing what we look at with quality, but in a nutshell, we basically want companies that are financially strong, have really good balance sheets. We love predictable companies that have consistent results, and then we also like companies that compare very favorably to their competitors and peers when it comes to their growth rates and their profitability. Those 4 elements all stack up into a percentile ranking, and I limited this to the top 20%. So there's only one that snuck in at 79 there. So that's the primary screen, and then for the secondary screen, I wanted companies that had fairly decent return forecasts, so double digits on the return forecast, in combination with, and again, this is just pretty simple math, PEs that are higher in the future and profit margins that are higher in the future. All 3 of those conditions are met. Now, this list, I want to caution you. I took the ones that had the highest potential profit enhancement. So what you're looking at in many of these cases are companies that have been just absolutely hammered. Their earnings and their net margins for 2020 are expected to be pretty meager. And contrasting that with where they are expected to be 3 to 5 years out, that's why those numbers are so large on the right-hand side. So Kim, would you be willing to walk us through the triple play that's actually on display here?
Sure. I'm a big fan of the triple play, and after the triple play, I've had some great home runs. So for me, when I look at a value line sheet, on the very top line there on this taskbar, you can see where the trailing PE is 18.9 that Mark has circled. And the current one has no meaningful data, which means I'm really guessing that the PE is really, really depressed as of currently.
Or possibly even negative earnings at this point.
Or negative, yes. But when you look at the value line sheet, the second line down on the far right-hand side in the boxes there, it says annual PE ratio going forward is expected to be 20. Now, as we all know, when a PE expands, what happens with the stock price? Goes up. The second thing I like looking for is when I look at the value line projections box going to 2023 to 2025. Notice that the low price right there, annual return is 42% to 55%. That's called cha-ching, cha-ching. And the last thing we like to look at is we want to have a company whose profit margins are staying consistent or going up. Now, I don't know what's going on with this companies, but where we had no meaningful data to 2.9, 8.8, 9.9, something happened where the stock price fell so far in 2020. But look at that going forward. A profit margin of 40%. You find this, the next thing you do is you go to the quarterly reports and you start reading that management's discussion of what's going on with this company and its quarterly reports. So that way you can take notes off of it to see what's the game plan here and what's going on forward. There you go. That's a cha-ching moment.
All right. So again, just to make sure we're clear on this one is most likely a non-core. There's quite a bit of speculation here. This is early stage. I know it's a biotech company. I don't know any of the specifics. But anytime you're looking at a company going from low single digits from their emergent period up to a net margin in the 40 range, which is not uncommon for a successful biotech. Again, this is, you'd want to dig in and understand this one pretty well if you were going to pursue it. And again, many of these companies are really damaged and hopefully not irreparably. I mean, I noticed that General Electric makes the list. I haven't been able to muster the energy to go back to GE after being burned a little bit over the years. But GE, if you believe that they are restructuring profitably and effectively, it could be time to go back. Schlumberger is another one that, thanks to the stuff going on in the energy patch, has been pretty tough. One that kind of jumps off the page at me, I have not studied it in any detail. We might do that in a future session. Varex Imaging. Any familiarity with that one at all, Kim? Ticker VREX.
No clue.
No clue. I know it's medical devices. I know that they're obviously in some form of imaging, so it'd be kind of interesting to see if they have any special hook, or what does that really look like. I'll probably do a closer study on that one. And again, the disclaimer being, this is kind of a special triple play. Again, some of these are turnaround situations. You want to be careful out there, but it is a source of ideas for study, certainly not a vetted shopping list at this point. Okay, so pressing on.
Mark, if we could, do we currently have a triple play screen on Manifest? Because we have that question in the question box.
Yeah, that's something we've talked about for at least 5 years and haven't done. It's near the top of the queue, and it might be at the top of the queue now. The next time that we actually do some coding, Kurt's got some version enhancements that he has to do anyhow, and I'll convince him to get in there. And I really think it's time to make the triple play a standing screen at Manifest. Okay.
Yep.
And just for kicks, here's a look now. Some of you have had questions about this. We put this out on a weekly basis for companies, so we call it the Parade of Opinions, just so you can see the projected returns, our rankings. We're going to talk a whole lot about Prove here in a second, PROVE. So we'll skip over that now. But what you have is a set of opinions from the Relative Strength Index. And again, I'm going to skip back to the screen because we're going to spend some time talking about some of these methods of looking for stocks. We're going to focus on just these here, Prove and most oversold. So low Relative Strength Index. So as I'm looking at this list and thinking about diving into it to pursue companies, I'm looking for situations that might qualify yet are closer to being oversold That's one of the other things that draws me to Verix, because it's actually in the 30s. So it's been punished and it's closer to being oversold. The strict definition of being oversold is a relative strength index, an RSI less than 30. But you can see it's the lowest number on this list. And again, I like to shop for companies that are trading somewhere close to that relative strength index of 30, because if the company does regain its footing, it can be quite a rewarding situation. The other thing that we love to do is find companies that are trading close to their 52-week lows. The 52-week position shown here is the range from the 52-week low to the 1-year analyst consensus target for the company. So anything down close to zero, again, is trading near its 52-week low. Again, Verix kind of jumps out. All right. Hugh McManus, since almost usually insists on getting that when it's down at 20% or less, and we've written extensively about that. The value line, low total return forecasts are there also. The Morningstar and analyst consensus estimate price to fair values are there. Anything under 100 is potentially on sale, might have sale tags hanging off of it. And again, the same old wisdom holds true that when that number gets to be too low, it could be too good to be true. I see a Schlumberger checking in at 38 here. Looks like my screen may have frozen up a bit.
Oh, it's not frozen for us.
Okay. Just my mouse trying to hide. I was just going to point out that, Schlumberger, again, could be one of those really damaged good situations. You want to be careful with that one. Okay. And then the 1-year analyst consensus estimate, don't pay a whole lot of attention to that, but I kind of use it as a tiebreaker. If I find two companies that I'm kind of equally interested in, and one has a very low expectation for the next year, and for instance, the one up at the top has the analysts, for whatever reason, don't have a high opinion of Alkerms for the next year, that might be enough for me to shop elsewhere on the list. I like it when I've got a bit of a tailwind, and lo and behold, that one that just keeps jumping off the page, Verix has the highest 1-year expectation, so that can be wind beneath your sails. All right, I want to close down with a discussion of a topic that we have talked about fairly extensively here over the last few months. I just want to spend a few minutes talking about it. What I find, like many of the things that we've discovered as we've dug in and done some fairly intense research, is it just takes us back home. What I mean by home is back to the core founding principles of the modern investment club movement. And what you're looking at here is an excerpt from an article put together by Cy Lynch called Muskrat Pageantry. That alone is worth a look. The address is there, but in that article, we basically made the point that we use the preferred procedure for every single stock analysis at Manifest Investing. And Nicholson talked a lot about the preferred procedure, and it really is just a matter of understanding the business model. But what we love about this observation is that the original stock selection guide had a graph of the revenues, the top line, top line for any company, the revenues, and the pre-tax profits and no earnings. Didn't even graph earnings. Didn't even pay a whole lot of attention to earnings. Didn't pay a lot of attention to price versus earnings, known as PE ratios. And that's kind of what this notion of what we're now going to call PROVE, P-R-O-V-E, and we're not sure that's exactly what we're going to call it, but it's a return on capital concept that makes a whole lot of sense to us, and it actually circles back to what we've seen over the years and these lessons. Ken and I presented this in a return on capital presentation back around Christmas time. And you can read some of the highlights there. We basically want return. That's why we're here. That's Kim's ka-ching moment thing. We want to think about owners. Keep calm and just own it. This relies very heavily on the work of Joel Greenblatt. That book, You Too Can Be a Stock Market Genius. We might take a closer look at that book in future months. But this notion of return on the thing which you own can be simply thought of as the profits. And the profits that we like the best are the Section 2A, profits from a stock selection guide, divided by the investment in the enterprise. That's where it gets a little bit different. We'll talk about that. The enterprise being the key word there, enterprise value for those of you that have studied that concept. All right. So here's what kind of why we really struggled with this notion of what do you call it if it's a return on capital, because there's 18 different flavors of return on capital, ROIC, ROC, using different parameters for forming that. This is the one that is comparable to what Greenblatt liked to use. I like the title because it really captures it. Projected return. And again, that projected return would be what you expect to see in profits 5 years out. We talk about the average over the next 10 years, but on a stock selection guide based study or a business model analysis, we're talking about the returns, the profits, the net margins 5 years out as representing kind of a midpoint or an average of the next 10 years. So that's our projected return. And on what? The return on the value. Well, what value? The enterprise value. So the return on the value of the enterprise, or PROVE. The formula is right there. The numerator is nothing more complicated than the projected pre-tax income, something that we've always looked at and what is graphed down here at the bottom on that old stock selection guide. That's this number down here compared to the combination of the stock price, and then here's the breakthrough from this weekend, total liabilities per share, and then you subtract out the cash per share to basically make a correction for how that affects the stock price. But basically that formula in the denominator is the enterprise value. So again, the stock price per share, the total liabilities per share, minus the cash per share. And where we have been kind of struggling with this over the last several months is there was a whole lot of noise and it's kind of chaos in some of the data. And Greenblatt actually talks about this quite a bit. And because we were using long-term debt per share. And what I've discovered is companies do a lot of stuff. I mean, I knew that. Companies do a lot of stuff. So when we're talking about liabilities, companies have all over the spectrum when it comes to long-term liabilities, current liabilities. You guys that are deeper into accounting, you understand this better than me. But when you start looking at it from a total liability standpoint, current or long-term, it really starts to kind of come together. So again, you can see the quote there. No different than going out and buying a restaurant. You know, how would you feel about an investment in a restaurant or a rental property? It basically comes down to what kind of rent kickback would there be every quarter or every year over the period that you own the company, and becomes a very simple concept to sink your teeth into. So again, go ahead,
Yeah,
Kim.
I was gonna say, I just think it's so important, especially right now where so many stocks that we follow, because money is so cheap, they have borrowed lots of money.
Exactly.
And this prove method proves which management teams are the best at capital allocation, because no different than you and I, we're investing in a company to make money, and you want to have a management team who's got great capital allocation skills. And when you can find out what these numbers are on what their prove ratio is, number is, you're going to find those companies where you have management teams who are great allocating the capital, which is, if you own the stock yourself, that's your capital, and you want to make sure that they treat it very fairly and that capital allocation is great, because you want to make money on this. That's the whole point.
Yep.
It's hugely powerful as far as I'm concerned.
So again, just think about it intuitively. I mean, the return that you get on any investment is obviously dependent on what you pay for it. That's true whether you're buying a car, bicycle, a residence. That's always true. And then the capital behind it all. Just as a frame of reference, this is from the December presentation. We just wanted to point out that the PROVE, the prove ratio, actually runs pretty close to the average par for the companies that we track the most. And so it gives it context. We know that a par right now of 9 is basically average. We know that we're always after companies that are 5 percentage points better than that. We're going to find that same type of general characteristic to be the case with this ratio. Okay, here's a quick look at the Manifest 40. I know it's a little bit busy slide, but what it says is we're taking a look at the 40 most widely followed companies. Widely, did I say wildly? Widely followed companies at Manifest Investing by our subscribers, ranging from the number 1, Apple, down to Costco. And the average projected annual return of that group of 40 companies is, let's call it 9%. The owners' projected return on enterprise value, prove, checks in at about 8%. And of course, the place that our attention is often drawn to is any of them that are dramatically different. I checked over the numbers for Tapestry, Coach, and the numbers for Air Lease, and that's going to be places where, maybe we want to think about the PEs. It can be an interesting audit of one versus the other, the difference between the two numbers, often coming down to ambitious PE ratios for some of the companies, according to either us or the analyst consensus.
Yeah, and I want to mention here, as an individual, when I look at my stocks, I want to make sure that I am checking what the ROIC is on these companies, but then I want to see, is there consistency within the management of keeping the same number or getting better, especially after they've had a acquisition. Air Lease is a company that they spend a lot of money on buying planes and then they lease them out. So I've always checked, full disclosure, we have it in our investment club. We like to see how that consistency of that prove what their ROIC is, how the management team has been able to manage the capital allocation to make sure they're consistently making money. Because if there's not consistency, you got to find out why. What's going on?
Good stuff. Here's a look at the distribution just to give you some more context. When you graph the PROVE for the 1,400 industrials in the standard edition, you get a very natural bell curve. And my theory is that the companies that are going to really attract our attention are the ones that are basically 1 to 2 standard deviations to the good side. Companies that fall into that realm of projected return for the studies that we do. And I just find it fascinating that there's just not a whole bunch of them out here. And what you're going to find when you dig a little bit deeper, Kim's already mentioned it, the amount of capital restructuring to more debt, less equity, and all that kind of stuff that's been going on is something that really challenges a traditional stock selection guide. You need to be careful with it and understand what's going on here. Here's a quick look at a company report. I think we'll probably take a weekly session and talk simply about everything on this page in the future. But one of the things that you're going to notice when we publish these going forward is the fact that this is now total liabilities here. All of the facts and figures that go into it are also here. You can see the context, again, being in that 6 to 8% range. That means that Apple was here, and the recent run-up in prices put it over here. That might affect my way of looking at it in a sell consideration a little bit, that it's not as far out of bounds as I thought it might have been. The nature of their long-term debt is there. That's unchanged. But what we're basically talking about is the analysis down here is independent of PEs. The analysis up here is not. So you really want to start thinking about, scratch your head over this one. If PEs are something which challenging, we're going to cover this in great detail as we really become familiar with this method. It basically takes PEs out of the equation. So we'll
Yeah,
be
Mark,
doing.
and I'd also like to have everyone recognize on your chart here, look at the relative strength index, the RSI from the March 26th value line for Apple. Nice and low at 42. Look where it is now.
Yeah, I think it actually topped 70. That's from a few days ago.
Yes,
Yeah.
but I hope the audience is recognizing, look at the price of Apple. It was $257.50. Look at that. That stock price has gone up like about 125 bucks. That's why I don't like to look at one metric and one metric only. I like to look at a combination, to look at the picture as a whole, to recognize what's going on with this company. And that's, you know, why in looking at those items, it's great to make sure that those items are on a checklist, that you're making sure you're seeing an entire picture to be able to make good decisions.
Yeah, and again, what it's basically doing is coming back to this picture, and reinforcing the stuff that really matters on that page. And in this case, making a decision about the growth rate of Apple, which we've pegged at 7%, then the analyst consensus would be pretty close to that. And that dramatically matches up with the slope of the red line over here. So we're talking about a company growing at 7%. The only thing between that and a pre-tax income is this projected net margin. So again, thinking about that 7% number, thinking about a projected net margin number, I drop down to the bottom here and look at this image. Again, that's basically section 2A of a stock selection guide. Value Line seems to think that Apple, for some reason, is going to be 23 to 24%. Yes, that's possible. It might require some realignment of the product portfolio, but I'm more comfortable noticing that it's been basically 21% for a long time. So in my study, I'm very comfortable with a number somewhere in that 21% range. So 7% growth, 21% net margins. Again, you crank through using the effective tax rate and everything else to get that 6% PROVE number. Projected return on value. Again, what value? Answer to the question, enterprise value. So we'll be digging in quite a bit deeper on this, doing some more studies, more screening results, and I just think it's an interesting, fascinating area of reinforcement that we need to collectively explore. Again, your reminder that 3 weeks from today, we will be doing the roundtable, celebrating our 10th birthday. We'll be out with a registration link here within the next few days, and it's been a lot of fun. Ken believes that there will be no costumes but possible prizes. Might be some
All
good, clean fun.
costumes will be by picture only. We will not be wearing them individually currently during the meeting.
Good stuff. So let's go ahead and open it up and see if anybody has anything on their minds. Anything they would like to see covered?
Well, we have answered a lot because Jennifer had asked how to set up a triple play screen on Manifest. If you want to go to the Manifest screening site and show Jennifer exactly how you did it, we could do that.
As far as the results for today?
What tests, how did you access the triple play screen after you get into the Morningstar site?
Yeah, I'm actually using the database at Manifest, which is powers the website, but is not like we talked about earlier. We need to make a button or a screening tool that'll work for that. Let me go ahead and jump over to the site, and we can at least demonstrate the screener and show where it will be when it's implemented. At Manifest, here's the stock search. We'll do a new stock search. And in this case, I'll demonstrate something fairly close to what we did. Going down to the Manifest rank, I'm going to find companies that are above 80. So the top quintile of companies when it comes to projected return and quality, I'm going to insist on pretty high quality. Let's look for returns that are in the 14 to 19% range. And again, you're going to get different companies because we're looking for different things here. But just a real quick look. And a fairly quick shopping list that is going to have a few banks in it because banks have been beat up quite a bit. But you see, disregard Siemens. Siemens in the current update will drop because the growth estimates were messed up by some M&A activity. That will be updated here within the next day or so. But let's see if we can find some interesting companies.
Oh, there's Size EPAM Systems.
EPAM has been very good to us, even better than Cognizant, although Cognizant's looking better all the time. Universal Display is a good study on here. EPAM, Size brought a few times to the round table. AbbVie is another one that's a decent study, not quite as flashy. But again, you can get to that. Let's do a quick, let me see if I've got, I don't know what we get for Hughes View. Well, Hughes View, which is simply looking for companies with financial strength greater than a B++, within 20% of their 52-week low, like I was saying, in a manifest rank of, he's actually looking at the top 1%. This is one that I had saved from a long time ago. I haven't even looked at it in years. But he ended up with Employers Holdings and Ralph Lauren, of all things. Interesting. Okay, other questions or comments?
Oh, I just responded to a question saying they would like a webinar on point and figure charting and setting up stop loss orders and the basis for setting a percentage on the stop loss order. So that could be an area for our education next.
Absolutely, and that's a great segue leading up to this. Can everybody see that on the screen? Life After Google is a book by George Gilder, and it's one that I've just started reading on the recommendation of Ken Kavula, and it dovetails into a conversation about Facebook. And I wonder, my wife is actually a charter stockholder in Facebook from the day of the IPO, and she's obviously done quite well. I wonder about the vulnerability of Facebook. And this book basically talks about the vulnerability of a lot of those major, there we go, Life After Google, again, George Gilder. And what we're probably going to do with Facebook, with our family portfolio, is figure out a trailing stop limit order to, continue to ride it on the way up, but certainly be willing to high five at the water cooler and walk away from it. If the stock price does take a substantial correction. I'm frankly amazed that it hasn't been correcting more. There's a lot of money. This is a topic for another day, but a lot of money on the sidelines and a lot of that money really churning right into the FAAAM stocks, which include Facebook, and are kind of an artificial support type of condition, in my personal opinion. So yeah, that will be a future topic, maybe a couple sessions out after I spend some time with that book. But the notion of setting a trailing stop limit order, it's also a discussion we've had with some people that are experienced people interested in capital preservation that happen to hold shares of the NASDAQ 100 QQQ mutual fund. It's actually an exchange traded fund, but some people are looking at that for trailing stop limit order application.
We did have a question, and about were we going to have this recording and would it be posted? And yes, that is what Mark is planning on doing. This is currently getting recorded, and it is to be placed up on YouTube later.
Yep, it'll be on YouTube, and it'll be most of the session notes and the slides and the video link will be in the manifest forum, right?
Well, yeah, and I was wondering, Mark, as I was kind of taking some notes, it'd be great if you could get that 1975 article in March by Nicholson about the triple play. Maybe post that with it.
I'll see if I can try to find it. I've got a collection of Nicholson articles that I'm not sure they're still on the Better Investing website. I think that anything that old may have got purged in the new website.
Well, all we can do is try. And then,
I'll try.
yeah, what about the July 26th article on the triple play? That one too? I believe you said there was a July article on the triple play.
Yeah, I'll try to find the two that I referenced in the session.
And what about size article?
Oh, that one's easy. That's one of ours. That's a Manifest Investing cover story.
Yeah, well, maybe you could put a link in there with that so everything's combined.
Anybody that doesn't want to wait for me, just go to Manifest Investing, go to the search, type in muskrat, think muskrat love, and hit go. And you'll be taken to muskrat pageantry and Dakota Abbott skinning muskrats and winning pageants. And it's an excellent discussion of the preferred procedure and why we do what we do and why I think it's so important to comprehend the preferred procedure and capital structure today.
There was a question addressed to me of how to study NERD on Manifest. And I have to admit that I'm trying, this is a new thing for me, I'm trying to recognize changing in behaviors in the market, the way Ken talks about, what's the term he uses, Mark, on
Disruptive
technology. And when I can see an art, I mean, literally, it started with me, with you, if you search disruptive technology on Google, you will find articles about different stocks and businesses that they feel are disruptive. And when I can see that somebody is making $100,000 to play video games, I'm like, are you kidding me? That makes no sense. So it's one of those things that I like to keep an eye on, but also, as Mark has said, where you look at the RSI at 79.38 currently, it might have gotten just a bit frothy, because if you look at the 50-day moving average is 1865 and the 200-day is 1613 and it's up to 2234. I do believe there's an opportunity that this stock could pull back. And when it gets back down to, let's say, the 50s in an RSI, that's when I would want to start looking at it. Again, I recognize the market is a voting machine. The market has voted that they believe in this stock and it has momentum and it's gone up. But everything goes up, everything goes down. So being patient would let us probably make more money, because if I presented that stock just because it's a change in technology, it's a disruptive thing that's going on. Who knows when we're not going to be wearing face masks and not can group together. It could be a year before we have Major League Baseball and everything that you can actually sit in the stadium and watch a game. So that was the big reason for me to present that stock, is it's a change in behaviors.
Yep. And for those who would like to play along, we will be adding this to our fund coverage. We're currently retooling our mutual fund and exchange traded funds right now. Hope to wrap that up here shortly, because we got to get that done before we can work on the triple play screen, frankly. But you could go to Morningstar. In this case, it's got one of the weirdest names ever, but the ticker is NERD from Kim's roundtable presentation. And then go to the portfolio. You could actually build a dashboard using the portfolio at Morningstar and basically take a closer look at Manifest while we're building our own commonly shared dashboard under the fund section. And let's see here. Where's my
And I want to
holdings?
remind everybody, what you're seeing Mark do, I go to my library and I get into Morningstar, and literally I have a simple sign on and a password, and I don't pay for it. It's just I sign in through the library, and there you go.
So you can
I
go,
have
go ahead.
I says I have access through my local library, and there are library systems, and I'd have to go back and talk to a girlfriend. There's I want to say there's a library in Virginia that I believe is $25, $30 a year, but gives you access to Morningstar.
Good stuff. Again, you could go to Morningstar, take a look at the actual holdings in the portfolio. Here's the top 10, and actually do stock studies and add them to dashboards. We will be operating right alongside you. Won't be for the next couple of days, but within the next week or so, we'll try to attempt coverage on companies that are not currently covered at Manifest Investing, and fill that out and see if we can't get a representative sampling to start to form some conclusions and be ready for it to be attractive and on sale at some point in the future. How are we doing on questions?
We've got, please add CARZ.
What was that? CARZ?
Uh-huh. Bonnie's asking that.
Yeah, that's the one I added during the COVID conference.
Yeah, and the other one, Bonnie is saying, have we ever looked at Reliance from India? Not me.
No, but I will.
And it is Fairfax Library in Virginia that will let you pay, I think it's $25, $30 a year, and you can get access into their library of digital information. Oh, $27.
All right, so we are at basically 1 hour. We would like to keep these sessions to about that. That makes it easier on YouTube, for one thing. But again, I would invite anybody in the audience to send me an email about suggested areas of coverage. We've already mentioned a few. At some point in the future, it's something I've always wanted to do, dig into point and figure charts, because there used to be a column in Better Investing. Len Reeser did it for years. What can we benefit from point and figure charts? And we'll engage the community to do that. And it's a good discipline to go through, and you don't have to use them, but you can understand what they are and form your own judgment as to whether or not they have potential. But again, any comments for topics, any specific questions, companies that you'd like to see covered in greater detail? Think about the frequency of about a 1 week thing. How does this time work for you? If you could pick any time of the day, let me know what that would be, and we'll be happy to consider the feedback that we get. It was my hope that we could do this in, basically during the business day. It's lunchtime in Seattle. Could be a brown bag lunch thing out there, so that it could be okay out there. But again, I recognize that this is during the workday for some people. The recordings will help, but submit questions and come back and check them later if you're in that work situation. So day of the week, time of day, any suggestion that you have, we will consider it. I do want to avoid a bunch of nighttime webcasts. We've got a few of those already. I just think this is a potentially good adjunct, especially if we get into a topic that we can explore in greater detail, whether it be a tool or a resource at Manifest Investing or anywhere else. Anything that helps a long-term investor join that group of bulls that we had on the cover slide just a few minutes ago. So we are bulls that like to help each other do better. Any other comments, Kim?
No, Howard said he did get audio eventually, just to let you know, and I think we've covered them all.
Okay.
I've tried to save all the questions for us so that we can review it later.
Okay. Well, thanks for your help, Kim. And again, let us know what you think and have some fun out there. And especially if you discover, it's a theme we're going to be talking about a lot over the next few months, an exciting, faster growing, small, excellently managed company, we need to know about it. Everybody needs to know about it. And we like to share those ideas. So thanks for tuning in, and we will see you in a week. Thanks,
All
everybody.
right. See you later, guys. Bye.